Wall Street moves higher after the Fed leaves rates unchanged, but what will higher for longer mean for investors? Welcome to Market Insight. I'm David Pollard. With US inflation stuck at 2.7% as measured by the PCE price index, Jerome Powell was clear on Wednesday that a rate cut is not coming anytime soon. Markets sighed with relief that he didn't point the way to further hikes and were rising in Thursday's session, but it's clear investors need to prepare for rates to stay restrictive perhaps until the end of the year. Well, to delve into what that will mean, I'm now joined by Greg Hahn, CIO of Winthrop Capital Management. Welcome, Greg. Many thanks for joining us. I know you don't see a rate cut until at least the fourth quarter, so what does that mean for investors?
So there's two themes. One is the inflation rate is sticky. The rate of inflation is just sticky right now, but it's below 3%. It's not at that 2% level. I think the concern was that we saw an uptick from 2.5 to 2.7 in the PCE month over month, which is, I think, caught markets off guard, a little bit alarming. But we do think the trend in inflation is still declining through the year. And the other piece of this is that domestic GDP growth is slowing. We're averaging 3%, but we dropped to 1.6% indication in the first quarter. So slowing growth with declining inflation, we would expect rates to come down, but the Fed's going to need to see more data before that starts to happen.
So all this debate, as earnings flow through the markets, we are more than halfway through this earnings season. What do you make of what we've seen so far?
I think the evidence of trouble, there is trouble in the economy. We think the evidence of trouble in the economy is flowing through earnings. Some of it's hidden, but we have elevated labor costs. We have tighter margins. In some cases, we have declining revenue. So we're seeing top line growth declining. So there is trouble, especially on the consumer side. And so we're just real careful, especially in that sector, with making sure that it's not that we're out of the stocks, it's that they're valued correctly. For our entry point, we want to make sure that we've got good value in terms of price entry.
Well, you mentioned those consumer-focused companies. I know that there's reason to be worried according to your notes. So with some retailer earnings falling and savings declining, what would your advice be on those?
So on the retail side, in the way that we describe this, David, if it sells its stuff out of a box being a storefront, we're very careful about whether it's a Walmart, a Target, a Dollar Tree. The thesis is there. However, the demand seems pretty fickle right now, with the exception of some of the wholesalers. Costco's been a real strength in the portfolio for us. So we're just real careful about that retail sector. But one of the stocks that we like that consumer focused is Nike on the discretionary side. We think there's value there. So there's still some value in the discretionary side. But watch the consumer. I think the real telling piece in the economy this summer is going to be how the consumer responds.
So with that in mind, if I were to ask you for some other stock picks, what ones would you name for me?
Well, we're very careful. So Walt Disney is a name that we've talked about in the past. We're still in Walt Disney. We think that that's cheap, and that's a wonderful story that's going to play out. That's obviously not related to the consumer sector, except in that streaming demand space. We still think that streaming still needs to work itself out. We're struggling with paying up for some of the growth stocks, but on the pharmaceutical side, on both sides, there's Pfizer is probably the cheapest we've ever seen it. And then Eli Lilly has just been a champ, and this whole market for obesity drugs is we're still in the early stages of that. But at 72 times earnings, you gotta kind of plug your nose when you're looking at making an investment in that right now. But those are two that we're active in.
And finally, Greg, I know also that you recommend moving money into fixed income. What's your thinking there?
Well, you have to go back, like in the last 2 decades, David, real rates of return for investors are at their highest levels in fixed income. And if it's the credit markets are investment grade credit is wonderfully priced right now. Spreads are very attractive. Municipal bond spreads are very attractive. So investors, even in short-term funds, can earn a higher rate of return than they've ever been able to earn. And the the issue is, well, Josh, what about the erosion and with the rate of inflation? That's always there. It's there across all your investment sectors. So risk reward is hands down. The bond market is so attractive for investors right now. It should be part of everybody's portfolio.
Okay, Greg Hahn of Winthrop Capital Management, thanks so much for joining us and sharing your thoughts today. That is your Market Insight. You can watch more videos on Reuters.com.